It's my great pleasure to welcome back Laura Keller from Bloomberg News, who is going to moderate our next session with Perry Mandarino and Patty Tomasco filling in for Ari Blout. And Laura, why don't I turn the floor over to you to talk about what you're going to talk about.
So we are happy to be able to welcome Patty Tomasco, who is a partner at Jackson Walker in Houston. And I think Patty maybe didn't have as terrible of a time getting here. So Patty is in the restructuring practice there, and she's been on some major cases for oil and gas, of course, Lynn Energy, I understand, and also Seadrill being one of your big cases. And currently, one of those great big ones out there, $20 billion of debt.
Yeah, we just, I'm a big advocate for the Southern District of Texas, and so we did Lynn Energy there, Seadrill, and also we just filed iHeartMedia, so.
Right, some big ones there.
Big cases.
Yes, and we also have Perry Mandarino here to my left. Perry is co-head of investment banking at B. Riley FBR, also head of restructuring there, and he's been on several very large in and out of court cases. Chrysler, of course, was one of those. And for anybody paying particular attention, he's also been involved in multiple Donald Trump Chapter 11 casino cases. So maybe you want to ask him a few questions about that after the panel. And Perry has also been an examiner and trustee in several situations as well. So maybe Perry, we'll kick it off with you then. You know, just maybe talking a little bit before bankruptcy. You know, some places where we can really look at ways to work out a company. And I know you're interested in companies that have what we would call maybe a story.
Sure. And thank you, Laura. And Patty, thanks for pitching in for Ari. We co-opted Patty last night to pitch in when Ari told us his plane got canceled. So yeah, I mean, we're all in the world of distress and bankruptcy. But with my firm's been doing a lot of actually for public companies actually that aren't yet that need liquidity, that aren't yet distressed but have a story, is something called a baby bond. Now, when you think of a normal high yield bond, they're in denominations of $1,000 and they go to institutional buyers. What a baby bond is, it's very similar to a high yield, but better. The interest rate is generally 6 to 8%. They're 10-year pieces of paper with very light covenants. Really, there's usually no call for anywhere from 2 to 3 years, and after that, there's no penalty to refinance. But what's most interesting about a baby bond is that they're the reason it's called a baby bond is that they're not in denominations of $1,000 per bond, but in denominations of $25 per bond. And it has to be for a public company because the baby bond, it has the same QSIP as the stock. So, for example, my firm, public company, our symbol's RILY. We did a baby bond issuance for an acquisition that we did when we acquired Wunderlich Securities. And the baby bond symbol's like RILYG. So it's publicly traded, so there's liquidity in the market, and it's really a retail product. And it's a product that is, fixed income product. It's, perfect for fixed income type of investors at, and I think our bonds went out at about a little over 7%. So it's a great tool. Now, but more than that, if you have a shelf registration, well, you have to have a shelf registration to do it. And if the shelf is still alive, you could do more at-the-market offerings of the baby bonds. So you could go back into the market and sell more baby bonds for other liquidity or for other, resources. So it's really a product that is not, it's well known, but it's not your typical high yield debt. And I think we've done between baby bonds and ATMs of at-the-market offerings for equities. I think in the past couple of years we've done like 147 different transactions. 3 for ourselves, the under 144 for our clients. So it's really a great tool to bring in liquidity. And so when we think of liquidity in our normal day-to-day lives, we're thinking about ABLs and traditional bank term loans and unitranches and first lien FILOs and traditional financing. So this is something that's a little different that could be used as a real effective tool. Again, public company, you have to have a decent market cap, but it's a good liquidity tool.
Yeah, and it was one, when you brought it up before, that I had never heard in 5 years of covering high yield and distressed.
Right.
I don't know if I'll quite go into my questions for you on how the retail guy will fare if things don't work out, but for a company that isn't quite in distress, it seems like a really good option.
No, it is. It absolutely is.
So, but Perry, don't you think that simply adding debt on top of an already troubled situation is probably not the right way to go?
Well, it's interesting, especially in like the retail sector, more leverage isn't a good thing, and I think the community's tightening up on credits, on leverage anyway. But in terms of a baby bond type offering, again, the company's not going to be distressed yet. It's going to be a company that needs liquidity and has good access to the markets. So, and what it does, it's an alternative to equity, right? Because we always think of our world like equity is wiped out, right? But these are situations where equity isn't wiped out. So the other big benefit is that it's non-dilutive to equity, where equity is still a real something that's valuable. It's interesting being part of. So my firm acquired a firm called FBR last year, which was a Arlington, Virginia-based, New York investment bank, and we now have 100 bankers, and doing regular way deals for someone who has done distressed his career was really interesting to me, because the mindset is just very different, but it's a mindset that I think is used and very applicable to exit financing and how a company will do after it gets out of 11.
I think the reason that's interesting too, because it sounds like that sits pretty low in the structure of the waterfall.
Yeah, it does.
Most of the time when we think about rescue financing, to your point, I think, Patty, it sits on pretty much on the top of the structure. So I don't know if we want to talk a little bit about some of the financings we found interesting from the perspective of maybe rescue loans. I know one that I've always been interested in over the years has been, one that we at Bloomberg cover a lot, has been Jefferies and the FXCM, Jefferies Leucadia. It was a $300 million loan that they actually got upwards of 20% on in some cases. So it was quite a nice structure, but it sat super secured. So I'm wondering, in this case, though, that actually didn't help out the company so much. Within 3 years, the U.S. operations actually filed for bankruptcy. So of course, for Jefferies, that turned out fine, but maybe not so much for the company. I don't know if I would categorize that one as a financing that worked out very well.
Well, that's my point. I mean, we always have to be careful that we're not just putting a Band-Aid on, a gaping wound.
Right.
And so, when I get a case, they're never in a good shape by the time they start asking for my help.
To come to you, yes, exactly.
So I don't have the luxury of doing a baby bond where there's still equity still in the money. It just is never going to be the situation that I face. And so I tend to caution against adding more debt on top of an already bad situation. I always look for ways to find liquidity within the structure itself already. And so that's, having just been asked last night to talk about this, I'm just going to talk about what I know, which is
but you brought up a very good point earlier when you were talking before about Seadrill and how they didn't add extra debt at all, but in fact used options to.
Well, actually, we're talking about Lynn.
I think possibly. I think it's back. Okay. Sorry, that was Lynn.
Yeah. So on Lynn, in Lynn, we had the situation where all the RBLs, sort of like had, if you had timed the RBL. At a particular point where you weren't coming up for redetermination, but you still had room left on your lines of credit. And what Lynn did, which was probably the highest dollar of any of these cases that I found out about, is that they drew down on their line of credit, and there wasn't really anything the bank could say because they were not technically in default at that time. Even though they knew restructuring was looming because of the oil and gas prices, and they didn't look like they were going to recover, Lynn was able to draw down on their line of credit to the tune of about $950 million. And so almost $1 billion on a line of credit that they drew down.
Before bankruptcy even hit.
Before bankruptcy even hit, this was like I think Lynn filed on May 11th of 2016, and this happened at the end of January of 2016. So what they did is, because the loan agreement required that they put all the money into one of the controlled bank accounts with one of the banks that was one of the lenders, they didn't. They put it in this small bank in Houston called Amegy Bank, which was hilarious because it was like this huge amount of money going into this relatively small bank. And of course, the lenders were furious about it. And so as part of the negotiation of the RSA, Lynn gave back about half of that to the lenders. But at the time of filing, they had, as you know, all this liquidity plus this unencumbered fund, because like I said, they took it out of the hands of the bank. So there was no control. It was cash. It was sitting in a bank that had nothing to do with the RBL. They had about $500 million sitting in a bank, and that was, you know, great for liquidity. But I was the one that had to deal with the U.S. trustee on how do we make that account compliant with 345, because that was more money than any of the banks were willing to subject to the collateralization scheme of the DIP bank account. So anyway, it was. You know, but they had plenty of liquidity, and in most of the cases that I've been on, particularly in the oil and gas, they haven't had, the liquidity has not really been their issue so much. Now, we represent the local counsel for the committee in EXCO, and that company did have a DIP. It was provided by, however, the existing 2L, 3L lenders who were also more than 50% of the equity, and so. But you know that's the one case, and I think that as these cases start to deteriorate further and haven't filed Chapter 11 until just recently, they're going to have not the same sort of robust cash and liquidity that some of the earlier cases did.
Right, but you mentioned though, Patty, earlier that because of this case happening with Lynn, really the impact has been these anti-hoarding provisions. So
right.
Maybe there won't be as much room
right.
for some of the other newer lenders with newer agreements to use that.
Right, I was explaining earlier that now of course all the RBLs have anti-hoarding provisions, which basically are meant to prevent the drawing down on the lines of credit and putting the cash somewhere else when they didn't really actually need that money at that particular point. They just needed it to have the extra liquidity.
Right, almost like a bargaining chip too for the RSA negotiations.
Yeah, so, you know, the loan... Well, it is an old trick. I mean, I can think of, you know, my bread and butter for the last, 30 years of practicing has been more middle market. And I'll get into a case and, you'll have things like all of your receivables have to go into this lockbox. Well, the lockbox is controlled by the lender. Well, you have a big, huge AR coming in. What do you do with it? You send it to another bank account, and then you file bankruptcy, right? So that the lender doesn't have it. You have to have access to the cash. And usually this only happens when you have a bad relationship with a lender, or the lender is, maybe not as sophisticated as you would like. It doesn't have, the long-term game in mind. But you have to have a lot of tricks up your sleeve, like, a good relationship with a vendor and say, with a customer and say, send this AR to this other bank account, and it's a huge one, and then you have enough money to survive the case. You also have to, I always look at my 13-week cash flow extended, a year or so. You have to find ways to make sure that works as well. But liquidity is the key, and if you don't have, positive cash flow without debt service, then you can't afford to file Chapter 11 anyway. So all of that's important before you put more debt on top of a bad situation.
And how about, Patty, in those situations, do the loan agreements have any knowledge provisions that the lenders could try to use to block the drawing down of the line of credit? That did they ask the company to make a representation that they don't have any knowledge that they may be in default soon?
They may have put that in now. In this particular situation, it was not that. It was a representation about the borrowing base being at a certain level and then not being otherwise in default and not being insolvent at that time. Now, that I think was a very tricky timing thing. I don't know how many cases it's actually going to work out that way, that you can make those representations and make the draw. But as I say, as a debtor's lawyer, I say, what's one more default under the loan agreement? It's even if it was, it's not like it's a criminal offense. And so
The question back there?
Yeah, I do. So when you do what you just said, how do you deal with the fraud element if you just diverted funds and violating the loan agreement? For $900 million.
Certainly, I think that there was some saber rattling around that issue during the case, but ultimately it worked out for everybody the way it was supposed to, and I think sometimes you have to take those risks.
A look into your mind, huh, as a debtor's counsel.
Well, because ultimately what you're trying to do is to make the pie bigger for everybody, and everybody is, before you file, is trying to grab their piece. And ultimately everybody at the end of the day is going to be happier if you keep the debtor whole and in good shape for filing, so that everything can be worked out on a consensual basis afterwards.
Those pesky secured lenders want their collateral.
Yeah.
You mentioned before a 2-on-3L, DIP lender. You said it was also the equity holder.
Right.
And so how did they come into that position? Was that part of their strategy up front, or did they buy into that, or how did
They bought into it. I think they kept on doubling down on their bet, and then they actually occupied all of the strata of the debt stack at some point, except for unsecured, of course. So yeah, I think that was. I mean, I think Exco is certainly a case in which you had a lot of whistling by the graveyard, and so the equity sponsors just kept getting deeper and deeper into it. So,
And isn't that the when you say you have a bigger pie for everyone? That's again believing the business plan. So in the example that Laura gave about that deal that filed within a few years of a 20% loan being offered. I mean, number one, if you have to, I would assume that any company that borrows money at 2,000 basis points, there's a high risk of failure.
Right.
Unless it's a bridge to something else, which sometimes happens. Sometimes it's a bridge to nowhere, right? But then it's all about believing whatever the business plan is and how real it could be and how outside the box it really is, right?
Well, and maybe that's actually a good segue into DIP financing and looking at the different alternative lenders and banks too. If they don't believe the business plan, it's going to be a little bit harder to want to be involved in that DIP if they're not involved.
well, but most DIP lenders are going to be at the tip of the iceberg, and whether or not the company fails or doesn't fail, they're still going to get paid, and that's the nature of a DIP. It's not so much that you can get creative with the DIP. The DIP's the DIP. You have different sources, and maybe you can get it out there for competitive bidding and get some good.
And that's, I think, where the creative part comes in.
Yeah, and get good pricing on it, But ultimately, it's this part where the problem is down here.
Right.
So.
Well, maybe we can talk a little bit about that, though, looking at the different financiers of DIPs. Of course, you have the traditional bulge bracket banks, but then you also have, another tier of banks, the smaller investment banking firms, for example, Perry, maybe yours is one, and then, of course, the alternative lenders. So I'm just wondering if you can talk a little bit about what those different strata desire in things. One thing that comes to mind for me, something I've been covering, has been Remington, of course, the gun company, that the banks who have been involved in their ABL, Bank of America, Wells Fargo, for example, they're not necessarily a bank who may want to continue to be involved in that structure on the exit anyway. Maybe not so much the DIP we're talking. But, in that case, when there's a traditional lender that doesn't maybe want to continue, where do you look and what are you able to give in terms of terms for other potential lenders?
Sure. I think it's about the risk of the loan, and then it gets tied into the yield and the coupon and the return for the lender. So ultimately it's the cost of capital that each of those institutions have. So the bulge brackets at the B of A, the Wellses of the world, their cost of capital is lower than a hedge fund,
right,
most likely. So.
But is there like a general rule of thumb that you have normally on, these that you normally want this kind of pricing, and then this set will
Sure.
demand this much?
Sure, and maybe we could talk it in the context of retail.
Sure.
Right? Because there's so many retailers out. And you can even take a case like Bonton, where you have Wells, B of A, a consortium of banks have an ABL of a few $100 million plus, and then there's a FILO, first lien, last out loan, of like I think 100, and I think they're perfectly happy to stay in there at a generally robust interest rate, given the collateral, given their probably have 2.5x of coverage on their collateral. So that pricing, the first piece of it, it's generally in a 5-6% and lower, anywhere from 4 to 6% all in, with the spread over LIBOR, generally being between 3 and 5. With respect to the second piece of the FILO loan, where they're pari passu on collateral but last out on payment, that's probably closer to anywhere, an 8 to 12% loan, depending on the nature of the collateral. So it's looking for yield, and they have different desires. But Laura, you cover Wells and B of A. Given all the especially around Wells, the turbulence in the market that they've had, what do you see from them, and how are they looking at these deals as you cover them?
Yeah, because Wells, as you point out, is a big lender in retail spaces, really all across the board. But what's interesting there is you would think that because they've had, and anyone who doesn't know, they've had these big problems in their retail banking side. So some people have thought, well, maybe they could lean a bit more on their corporate banking side. But what's been interesting is you haven't really seen them going out and trying to, maybe give a little better pricing or really push forward to get more clients, which I think is quite interesting in this case.
Right, because they have some government restrictions.
The Fed is actually on their backs not to go any bigger. So,
right.
But they've been careful to say that, of course, doesn't apply to their corporate clients. So we would think maybe they could push a little bit further on that.
Right. And how about in terms of political risk? How do you see that?
Yeah, I mean, going back to the Remington example, you have this debate, of course, in the country with guns, and I don't know that you see every bank really wanting to fund that. I think back often to Deutsche Bank and pulling out from funding anybody dealing with coal. That was a decision they made eventually, and perhaps you see that with something like a Bank of America or a Wells Fargo,
yeah,
where they choose not to.
And coal's a whole different ball of wax, because the coal industry, not almost every, but a majority of the coal producers in the United States filed for bankruptcy between 2011 and 16. It was just incredible. Talk about retail, talk about oil and gas.
Which maybe goes to operations as well. Maybe it's
Yeah.
not just political risk. Maybe some of these gun companies, for example, don't have as much of a reason to exist
Right.
on themselves.
Right. So coal is competing against oil and gas and alternative energy and solar and wind. So that's the risk that those lenders have. Guns obviously is the zeitgeist in the nation right now. But what happened? So what's interesting in coal is that all the coal companies that have come out of bankruptcy more or less have no debt, or very low debt. They'll have a revolver, but for Consol Energy, which has 2 times leverage, right? And so the bellwether now for coal debt is 2 times leverage. Now there's some other private companies that have a little bit more, but interestingly enough, we're involved in an equity raise for a pretty major coal company, and when we've gone to the banks on the refinancing of their debt side to get the cost down a little bit, they're pretty stuck on 2 times leverage. I mean, 2 times, and why? Because the price risk is so great, right? Right now, if thermal coal is selling at whatever, these guys sell it for between $80 and $100 per ton. It could go half that, and I guess even in oil and gas, Patty. I mean, whatever happens in Saudi Arabia, wherever else, all of a sudden they could decide to turn the spigot back on.
Well, for sure, and that was one of the early skirmishes in some of the early oil and gas cases was how do you measure diminution and whether or not the commodity price fluctuation should be calculated as diminution in your cash collateral order. Same thing would be true of a dip order as well. It's like, who bears the risk of a commodity price collapse? And we fortunately never got to that, because most of those cases filed when the oil prices were, in the 30s, and we ended up with, confirming around 50. So, I mean, we never had the diminution claim to consider that. But I did do a lot of research into, what is the definition of diminution for purposes of adequate protection under your cash collateral or your DIP order. It's actually a really fascinating topic. But you do see around the commodity price, heavy debtors, a lot of caution, because of we don't really know what the commodity price is going to do. I think that's true of coal, oil, and gas,
Right.
a whole lot of other things.
Right, because it's thrown, it's very difficult to do evaluation of something in a year from now. You have to make an assumption, and you could look at all the research, but they could be wrong, because, they won't know if X will happen if, God forbid, there's another horrible hurricane that knocks out production in Houston for 6 months or whatever.
Right.
I mean, but what's interesting, I think there's been a little bit of an offshoot of oil and gas, and it's a little off topic about financing, but since we're talking about it, is that you have a lot of the providers to the oil and gas industry, like storage facilities, which still aren't out of the woods, in my view, because there was so much capacity built to store the crude oil that there's a couple companies out there that are having some big problems, because if they could store, for example, 10 million gallons at any one time, their average is like 2 million. Unless the Koch brothers want to come and fill them up, it's hard to be a successful company with very low revenue.
Right.
So I'm not sure it's over.
Yeah, we refer to that as sort of the downstream.
Right.
We have midstream. There's a lot of distress in the midstream companies as well, but they're not nearly as affected by the commodity price as the E&Ps are, and
Right.
so you see some of them surviving and some of them having difficulties. There's been quite a few oil and gas servicing companies. Seadrill's one of them that we did, and really it's just a matter of, it'd be more like a traditional company that just doesn't have as much work as they did when the oil prices were high, but it's not quite the dramatic collapse you have at the E&P level.
Right.
Right.
I want to zoom out, though, maybe a little bit from these industries. Retail, we've been talking a lot about, and of course, it's a big topic here at the conference today, and oil and gas. But I want to understand a little bit better about the credit cycle and how that plays into how creative you can be. Does it make you more creative because there are fewer lenders who are interested, maybe, who would have been there otherwise? Or does it actually go the other way?
I mean, correct me if I'm wrong, but I think there's a lot of money out there, and what we have right now is companies that have been propped up for too long by the access to capital, as opposed to the credit being tight right now. I don't see that.
But on the idea that maybe it's starting to tighten, and you don't want to be the last
maybe
one
it's starting.
financing?
Yeah, maybe it's starting to tighten, and maybe it's going to be more like what we saw, in the, when I first started practicing in 1988, a long time ago.
Many cycles since then.
Many cycles ago. But yeah, what we see is, like I said, I think the companies are, when they get to us, they tend to be over leveraged, and the larger companies obviously are much more well managed than the middle market companies. But we see a lot of companies come to us not in a condition to be rehabilitated at that point. It's just too much.
A little down on the third level.
I mean, listen, I think when Einstein came up with the definition of insanity, doing the same thing over and over and expecting a different result. He was looking into a crystal ball about the lenders and the late 20th and early 21st century, because the cycle is exactly that. I mean, I bet, and Patty's talking about her Lynn example, where her client was able to draw down $1 billion, a few months before bankruptcy. It's because the credit agreement, when it was probably done in 2012, would have been my guess. Mm-hmm. The credit agreement allowed it because that was market, right? So you talk about, Laura, it's a great question because credit cycle. And so you have, covenant-like deals You have no covenant deals, what I talked about before, the baby bond market, which essentially are no covenants other than, your standard, negative and positive affirmative covenants related to corporate existence and so on. It's the market, so you'll have a lot more flexibility when there's pressure for lenders to put out dough in the marketplace to get that return. And I think we're at this weird inflection point right now because you have a ton of alternative asset money out there that's available to credits. You have lenders that have a lot of pressure to put money out there, but you also have an environment where there's some fear that how stable will this economy be. The Fed had predicted that growth in the U.S. would be 2.5%. The GDP would grow 2.5% this year. They just revised, and that was at the end of last year. They just revised it that growth is only 2%. You have a somewhat unstable, that's the wrong word. You have a government that isn't normal, given past times, how it operates, how the White House operates. You have an ineffective Congress. And so you have all these macro issues. How strong is the economy? And so I think lenders are taking some risks. We closed a deal last year for a consumer products company, about $200 million, a unitranche deal, with a bulge bracket bank and an alternative lender. The yield on the paper, was probably, I think it was probably like 7.5%, 8%. But it was based on a business plan which at the time seemed, pretty conservative. Well, it's not that conservative, and who knows if that company will enter a Chapter 11 soon. You have, the Chapter 22s that happen all the time. Forget about retail, and I bet you'll see a couple of retail Chapter 22s this year, of cases that confirmed in the past year. So, the financing markets to me are all over the place. I think and Patty said it about management teams. In my view, and even in, as with, in my firm, as we do certain lending things, we look to the quality of management. And ultimately, in my view, finance will come down to the core operations of the business. What do they sell? Number one, and how good is their market? But maybe even 1A, or maybe even number one, is the quality of management, right? Because management could solve, good, thoughtful, mindful, forward-reaching management could avoid problems.
Well, even if you, yeah. And so sometimes as debtors counsel, I frequently find myself, of confronting a management team that maybe doesn't have even a cash flow budget to put in front of me. And so that's when I call in somebody like Perry and say, I can't fly this plane if the window is fogged up, so, which is basically what it's like to have sort of a management team that's not focused on, just they tend to think about things from a share price perspective, sort of very macro things. And when you're in distress, you really have to focus on one thing and one thing only, and that's cash. And how do you dig yourself out of that hole? And so, and even if you're probably not even talking about companies that are distressed or close to bankruptcy, but management does have to make that pivot pretty quickly when you start getting even close to that territory and watching out for how you're going to get out of it.
Right. Because how many times have companies not been close to bankruptcy in January and are having first day hearings in July? Right. And it's recognizing the fact that you have to change your focus is the problem, because the management team was put together, based on, a rosy outlook, and the skill sets you need to get a company through a Chapter 11 or even through a distressed period are different.
So it sounds like what we're saying about some of the credit cycle, from the lender's perspective is, things macro-wise aren't maybe so great, and maybe will get us eventually to more on your doorstep, Betty. But at the same time, it sounds like we have a lot of this cash flowing around, Perry, and so the general stance is for a lot of these lenders to they need to put it to work.
Right.
So I guess I also wonder, knowing that they are of that mindset where they'd like to put it to work, are there certain things that you see lenders demanding in terms of protections at all? Maybe I don't know if the market is there. If it's market to not demand it, maybe they can't. But are there things that lenders have been able to put into agreements such that they can be a little bit protected, whether the credit cycle changes or what we're talking about, management doesn't do what they should be doing?
We see a lot more interest in the exit financing. I think there's some competition around that. And even the top line dip, I think there's competition around it. Because if you think about, you have these little pockets of distress, and obviously you'd want to lend into a healthy situation. But, as you get, farther down the desirability cone of potential borrowers, you're going to have to start thinking about, it may not be that healthy of a company, but where do I want to lend into? And so what we're seeing, me in my career, I'm seeing a lot more interest in the high level dip, and then the exit financing seems to be very competitive right now. There's a lot of negotiations around that in the RSA compared to earlier time periods.
And what kind of lenders would those be? Is that the alternative lenders coming in?
Yeah, private equity, the people who bought into a debt stack, as it became distressed, with an eye towards being in, some kind of exit financing or rights offering as the company came out of bankruptcy.
So that's interesting. So is it possible they're looking for a 22, like they want to be there in the catcher's position to take over the business if it files again?
No, perhaps, but what I'm really seeing is that they see a distressed situation in a way to leverage where the bond is trading pre-petition, taking advantage of that low price and trying to catapult themselves into a higher position on the exit, whether that be in private equity, particularly in terms of having the rights offering or the exit financing or a combination thereof.
Yeah.
So.
Are you seeing more competition for dips and some priming deals happening, or what's the state of
I haven't. So early in my career, I was involved in the Sweetland development case, which was the first case. It was in the Third Circuit in New Jersey that the Third Circuit basically said it's impossible to prime, and so when clients come to me and say, well, can we get a priming? I generally say no, unless the circumstance is so extraordinary, right? Really extraordinary to have that, cushion in the collateral and all the proofs that you have to make. And there were a couple other cases,
Yeah,
right?
no,
The one in Texas.
Right. Well, like on Exco, they were taking out the first lien dip.
Yeah.
And then they also were the 2Ls and 3Ls, and so that worked out fine. There wasn't any issue with priming other liens.
Because if you have that much collateral where we could say that priming is appropriate, then I can't imagine how that
You're in bankruptcy.
the lender would the existing lender wouldn't do it, or just have enough to take the whole lender out.
In what percentage of cases, roughly your experience, does the senior incumbent lender become the DIP lender as opposed to being outbid by a
Most.
Yeah.
It's cheaper.
Honestly, it is cheaper.
It's more efficient. Listen, there have been cases, right, that we've all seen that you have an alternative lender than the existing incumbent lender come in with the better deal, but in the debtor's business judgment, they determine that having the existing lender is better, and I've testified to that before, and the circumstances vary, but many times that is true.
Yeah, and in some of these larger cases, it's just physically difficult to change lenders.
Yeah, Larry?
So, Rick, we started talking about the baby bonds. What's the time frame for when you decide you're going to do that to actually execute it?
We've gotten baby bond deals done in 2 weeks because it's public. So once you have the
shelf.
if you have to have the shelf registration done, Once you have your book done, you go to the retail investors and, with the retail sales force, you tell the story. We've closed baby bond deals. We've gotten hired on a Monday and closed a baby bond deal by the following Friday. So 12 days. It happens that quickly. Yeah, there's a there's a deck and offering memo. Yeah, of course. That's what takes the time, is to do that.
Do we have any other questions? We're sort of getting towards the end of time here. Anybody else have any questions about what we talked about, or financings in general, and or alternative lenders, I should say?
Yeah, I would say the one thing, Laura, that you had asked that we didn't get to answer is, what are lenders demanding in sort of a more stressful or a distressed type of deal, and they demand a lot of control. Of course, not equity control, because they would never want to do that, but provisions of stock pledges, of lock boxes, of the baskets where the company could do other types of financings are very low. Just a lot of short leashes is what I call the short leash provisions of loans.
And do you find any of those that are particularly effective, Patty, at all, that maybe keeping people out of chapter, or maybe helping once they get in?
You're asking the wrong person, because I think all distressed companies should file Chapter 11.
I think so. That there's some.
No, but, at some point, you can grab assets as a lender and kill the company, and you can restrict what the company can do to the point where it just withers away and dies. And it's not good for management to agree to those kinds of things. And so, a lockbox really will handcuff a debtor from being able to get to the liquidity they need to file Chapter 11. If you're a wise lender, you're going to recognize that the company needs capital to operate, and that you don't want the company to fail ultimately, because all that happens is you get an unsecured creditors committee with no assets but litigation. Who wants that? There are quite a few. The lockbox, the restrictions on where where customers can send their payments, and that sort of thing will really hamstring a debtor from filing Chapter 11.
Yeah, it sounds like there are some that are sort of detrimental. That's one thing that I wonder. As if you're a lender, if you're pushing for certain things that, to your point, Patty, you almost have. It's a detrimental effect to the company itself at some point. Why lend?
And it has to do with the capacity of the workout team at the bank. I mean, some of them are really good, and some of them this is their first down cycle, or this is their first, they got moved in there because they weren't doing well on the retail side. So there's all kinds of problems with who you're dealing with at the lender as to whether or not you're going to have a successful relationship that basically preserves value for all concerned. So if there's, part of it's in the document, and part of it's the attitude of the people working on it.
Just to defend the lender for 1 second.
We're happy to have that.
Larry?
Just to defend it, you put these guidelines into our communication and discussions with the broader spectrum. When a lender comes in, potentially is an equity sponsor. That equity sponsor is getting a free pass in the respect of he or she has now walked away from the company, distressed, maybe not wanting to put any more money in. And now it all falls back to the lender. So the lender has to put in guidelines to be able to get the table to talk. Whether the end result is a bankruptcy or a liquidation, it is what it is. But otherwise, the whole cap stack loses money. At LIBOR 175 to whatever, you shouldn't have to be taking that type of a risk, so you want to get the table to be able to chat.
Right. It's you call guidelines, I call short leashes, but either way, I think they're appropriate. And but one of the biggest short leash out there is government regulation, right? And now with again the current administration, maybe some relief on Dodd-Frank and other issues, but I would say, and maybe in closing, is that I think the lending market's going to be incredibly robust. Except if one thing happens, which is the three most fearful words on Wall Street: and that's President Elizabeth Warren.
He's doing that because he knows I'm a big fan.
We'll leave the debate there. Thank you guys. Patty
Thank you.
Tomasco of Jackson Walker and Perry Mandarino of B. Riley FBR. Thank you guys.